Hello, welcome to latest wealth online classes. I'm Kailash here. I'm a financial advisor as well as wealth coach. My dear friends, today we are going to discuss a very important topic, that is fundamental analysis. Let us go. What is fundamental analysis? In earlier class, we have discussed that there are two types of analysis. One is fundamental analysis and another is technical analysis. This fundamental analysis we are going to deal today. Actually, fundamental analysis is one type of stack valuation method. Actually, in this method, what we do is we use financial and economical analysis to find out the movement of stock prices. The fundamental data that is analyzed could include company financial reports, non-financial information such as estimates of its growth, demand for products sold by the company, industry comparisons, economy-wide changes, changes in government policies, etc. Actually, the outcome of fundamental analysis is a value. Outcome is value or range of value. That is called intrinsic value, means or price target. People call it as a price target or intrinsic value. Actually, this word was coined by Warren Buffett, one of the best investors in the world. Actually, if you want to become a fundamental investor, market price of the stock, he believes that market price of a stock tends to revert towards its intrinsic value. If the intrinsic value of a stock is above the current market price, the investor would purchase the stock because he believes that the stock price would rise and move towards its intrinsic value. If the intrinsic value of stock is below the market price, the investor would sell the stock because he believes that the stock price is going to fall and come closer to its intrinsic value. To find the intrinsic value of a company, fundamental analyst initially takes the top-down view of economic environment, the current and future overall health of the economy as a whole. Top-down. What is top-down analysis? And what is the bottom-to-up analysis? Bottoms-to-up analysis means some of the retailer investors, what they do, directly they'll go and buy one stock. After buying a stock, they start praying the God. They start worrying whether it is going up or not. If the stock price goes up, they'll feel happy. If stock price goes down, they'll feel sad. Instead of that, if you go from top to bottom approach, you can be more confident and you can make more profits in stock market. Actually, everyone got different investment process, but core steps probably contain the following elements. The fundamental analysis, general basic steps we are going to make a list. 1. Understand the company. One is understand the company. Here, some questions will be raising. How do they make money? It's about company. How do they make money? What is the business model? What are their products or services? Generally, all these details you can get from their company website. So if you log on to their company website, any particular company, you can get all the details from their website. Nowadays, this is a good idea. And you can read from some other financial magazines. B. Who are the clients? Is it B2B? B2B means business to business, or B2C, or business to customer. For example, B2B means generally Infosys, Wipro, these people, they give services for some other business people. That's why they called as a B2B. B2C means directly business to customer. Suppose one Britannia Industries is there, they supply the items to the retailer people. So whoever eats the biscuit, they are the customers, right? So that is B2C. How concentrated is its client base? C. Who are their suppliers? Are they overly reliant on supplier or raw material? If you have access to one website called Bloomberg, they have supply chain data for some of the largest companies. Now, the second point involved is understand the industry. What are the trends in broader industry? Industry report and niche websites of your first step here. Next, what is a competition like? Finding the market share information can be useful here. Although often difficult, sometimes industry reports contain this. You can also look at related companies through financial sites like Google, moneycontrol.com, Economic Times, BSC, and other websites. What are the macro risks? Are there structural changes to the market? Is there a risk of disruption from technology? Sometimes what happens if a company is preparing all old model, any new things comes, the company may go into losses. Again, industry reports and websites should give you a good sense of this. Three, analyze the company. What are the current initiatives management are pursuing? Transcript and management discussions, analysis in annual reports. B. How will revenues, costs and earnings change in coming years? Will they gain or lose the market share? Identify execution risks, external risks. What could go wrong with your investment thesis? Next, fourth point is value of the company. Build a financial model and come up with fair value for company. Sometimes choosing the valuation methodology is more important than the valuation itself. So make sure you are familiar with few. Typically, I am more concerned getting the direction right than magnitude by very precious. What I mean to say is, instead of going very, very fast, go in the right direction is more important than the going in a wrong direction very speed. Going slowly in right direction is more important than going fast in a wrong direction. Next, compare with consensus. It's okay to be apart from consensus. There is more for a sanity check to make sure I have not missed something very important. For that, you can refer a lot of websites which are very public. While doing the fundamental analysis, you have to ask the following questions. Please remember, these are compulsory before going into deep. However, in earlier next episodes, we are going to deal how to do the fundamental analysis. How to do fundamental analysis we are going to deal. Before doing the fundamental analysis, you have to ask the following questions. 1. What is the general economic environment in which company is operating? Is it constructive or obstructive to the growth of the company and the industry in which company is operating? For first question, let me tell you, for companies operating in emerging markets like India, economic environment is one of the growth, because in India, population is also one of the best reasons to invest. Growing incomes, high business confidence. Suppose one company where you want to invest, if it is a company is in a very small economy like a very backward countries, or some of the places already developed but economy is saturated. Where economy is saturated, the incomes are stagnant. Whereas in India, population is growing, economy is growing, so here incomes are going to rise. Next, second question. How is the political environment of the countries? How is the political environment of the countries, markets in which company is operating are based? Generally what happens is stable environment supported by law and order in the society leads to companies being able to operate without threats such as frequent changes to laws, political disturbances, terrorism, nationalization. All these problems will not be there if the government is stable and world is running. Stable political environment also means that the government can carry on with progressive policies which would make doing business in the country easy and profitable. Third question. Does the company have any core competency that puts it ahead of all other competing firms? Means some companies will be having some patented technologies, or they are in a leadership position in a particular segment. So that what happens? That potential makes them to ahead of the industry in general. For example, if you consider two companies, one is Reliance Industries. Actually, Reliance Industries' core competency is low-cost production model. Whatever they create the product or service for the country, they create in a low-cost production so that they want to serve more people with lower margins. For example, see the Jio. When Jio has entered, within a span of 1 or 2 years, they have got 20 crore subscribers. Whereas Apple is entirely different. Apple is designing and engineering capabilities. They focus on the premium customers. Next, fourth is you have to see one more example I can say about Maruti car and BMW car. In third point, see, Maruti is low cost and this is one of the top company in India, whereas a BMW, Lamborghini, these are the companies, they sell for premium customers. Both are having a good market capitalization. Next, let us come to fourth. What advantages do... Fourth is what you have to find out before selecting the company. What advantages do they have over their competing firms? Some companies have strong brands. Some have assured raw material supplies, while others get some government subsidies. So what happens? All of this will help companies to gain competitive advantage over others by making their business more attractive in comparison to competitors. For example, consider one steel company. Suppose it is having its own captive mines, iron ore and coal, their own. And suppose they are having their own electric supply also. So what happened? The raw material price fluctuations will not affect the profitability of the company. Suppose one power generation company comes agreement into power supply. So what happened? Because they are generating the power, they need not worry about the price fluctuations. So they are giving the raw material. So they are perceived to be low risky business, because what happened, their production cost will not be varied by other manufacturers. Next, fifth question you have to ask is, does the company have strong market presence and market share, or does it constantly have to employ large part of its profits and resources in marketing and finding new customers and fighting for the market share? Actually, what happened when the competition generally, it is good, it is bad. For example, competition generally make companies spend a large amount on advertising, engaging in price wars by reducing the prices to increase the market share. So when they are doing all these exercises, their profits may start coming down, and there are chances that their margins may come down. For example, if we take into Indian telecom industry, there is a heavy competition between telecom operators. So what happened? When each company is competing with each other, there is a profitability issues. Vigorous fight for market share. That's why a lot of telecom companies, they could not make more profit. For example, on the other hand, if you see some other companies where the competition is very less, even though less, if they are having a unique product, then their margins will be more. Whereas some of the companies, almost they are having a monopoly. If any company is having nearby monopoly, that means it can create wonders in your life. My dear friends, let us go into steps into fundamental analysis. The fundamental analysis, in coming episodes, we are going to create how to do fundamental analysis. One is macroeconomic analysis, which involves analyzing capital flows, interest rate cycles, currencies, commodities, indices, etc. Next is industry analysis, which involves analysis of the industry and companies that are part of the sector. Next, a situational analysis of the company. Next, a financial analysis of the company. How to read the financial statements, profit loss account, balance account, cash flow accounts, then ratios, then valuation. With this, we are concluding this particular part. Please watch next episode also, so that you can have a full idea. Thank you very much. Kailash is logging off. Bye-bye.